Let's start with the smartest and work our way up to the stupidest types of investors in the stock market. Number 9. Politicians. Every year since 2020, US politicians beat the stock market, with many in Congress making unusually timed trades, resulting in huge gains. In 2023, the Democrats absolutely dominated their Republican counterparts, with the Dems being up 31% and the Republicans only 18%. While SPY was up 24%. Many of these politicians continue to trade despite massive conflicts of interest. When people hear insider trading, our good old friend Nancy comes to mind. This is because she's the Speaker of the House and her husband also happens to conveniently own an investment fund. Paul Pelosi has sold shares of Visa valued between $500,000 and $1 million. Less than 3 months before, the feds hit the credit card company with antitrust charges. Now Nancy wasn't the best trader politician as she only made 66% return in 2023, while Brian Higgins made 239%. He's just a very smart trader, guys. In 2020, several senators sold stock at the start of the COVID-19 pandemic. They sold just before the stock market crashed in February 2020, using knowledge given to them in a closed Senate meeting. The Department of Justice initiated a probe into these stock trades, but of course, no charges were brought against anyone, and nobody was found guilty. Like it or not, politicians play a very smart game. They trade on information only they know, and make bucket loads of profit from it. Number 8. Quantitative funds. Quants are the big money or smart money in the stock market. Quant traders are like wizards in finance, but the only magic they perform is making people instantly bored. Quants are at the forefront of investing on Wall Street. Mathematical investing. Armed with advanced degrees in maths, physics, and computer science, they use complicated algorithms, data models, and statistics to execute complex trades. Quants move billions in the markets and are behind some of the most sophisticated trading strategies in the world. The best quant fund, Renaissance, has earned over $100 billion in trading profits since its inception in 1988. This translates to a 39.1% average net annual return between 1988 and 2018. No wonder us traders are always losing money. Quant traders will be running a complex model to predict if, 5 days from now, the temperature in Texas will be 4 degrees higher than expected, allowing them to profit from the spike in electrical demand and the slight uptick in oil pipeline costs by a fraction of a cent. Yep, that's who we're up against in the stock market. Good luck. Number 7. CEOs. The Forbes 100 is composed mainly of people who are worth billions in stock, by mainly not investing in companies, but actually founding them. You find extremely smart people who made billions by investing in themselves, such as Elon Musk, Jeff Bezos, Mark Zuckerberg, and my favorite CEO that I personally look up to, Amaranth. Some CEOs are also brilliant investors outside their own companies, leveraging their business acumen and networks to build massive portfolios. You want renewable energy? You produce it. You want a sexy electric vehicle? You design it. You want humans to go to space? You make the rockets. One nice perk that you can notice from people who got rich from the stock market is that they suddenly get a better physique, they get a wife upgrade, and that money apparently cures hair loss. Who would have thought? The stock market is not only extremely complicated for average traders like you. Just because CEOs are the third smartest types of investors doesn't mean that they don't make any mistakes. When Warren Buffett became friends with Bill Gates, he told him to diversify his portfolio, and he sold Microsoft shares. If Bill Gates had held on to those shares, he'd be sitting on an extra $1.2 trillion today, boosting his net worth by 10 times. I bet if Bill Gates knew, he would have shown Buffett his new Windows system and how it really works. Hey Warren, come look at the latest Windows operating system. Number 6. Index investors. Index investors are the marathon runners of the stock market. They believe slow and steady wins the race by investing in broad market indices like the S&P 500 and the Nasdaq. These investors aren't chasing the next big thing. Instead, they rely on diversification and low cost to build wealth over time. In a world full of market hype, they stick to the basics, and it often pays off. These are typically your r/investing users who treat the stock market how it was meant to be treated, like a smart, calculated wealth-building tool, not some casino. One of the main reasons why index funds outperform most professional investors is their low cost. Actively managed funds, where fund managers pick stocks in an attempt to beat the market, often have high management fees and transaction costs. While index investors may seem slow, they're some of the smartest investors, as they've historically outperformed many different types of investors. Index investor outperforms a hedge fund manager. It's like finding out that the tortoise wasn't slow, he just didn't need a fancy suit. Number 5. Wall Street. Wall Street is the heartbeat of global finance, where investment bankers and hedge funds battle it out daily. These investors have the inside track, access to vast resources, and sometimes questionable methods to stay ahead of the game.
You can't foment. You can't create yourself an impression that a stock's down. But you do it anyway because the SEC doesn't understand it. This is actually just blatantly illegal. By the way, no one else in the world would ever admit that, but I can care.
That's right, and you can say that here.
I can't. I'm not going to say it on TV.
On a side note, ignore Jim Cramer sniffing a lot. He just had a slight cold while he was recording this clip.
Damn. 10 million in capital.
Whether you see them as financial wizards or corporate traders, there's no denying their influence on the markets. For a hedge fund manager, there's nothing scarier than a drug test, tax season, or any year the S&P 500 beats their returns. So, basically every year. Prominent figures on Wall Street include people like Michael Burry, who was a doctor and worked as a neurology resident before he left to start up his own hedge fund, which became extremely successful. Michael Burry was one of the few people to bet on the financial crisis in 2008, with his fund, Cyan Capital, recording gains of 489% after fees and expenses. Something of note is that he has also successfully predicted 13 of the last 2 market crashes. Number 4. Cathy Wood. The stupidity is really starting to ramp up with our friend Cathy. Known for her bold bets on disruptive technologies like Tesla and cryptocurrency, she's beloved by fellow degenerates who dream of massive gains, but she's also hated by all those who've actually owned her fund. The flagship ARK Innovation ETF is down 72% from its February 2021 peak, and some of its top bets are still floundering. Analysts did some digging and found out that she's managed to lose a staggering $14 billion for investors. Cathy was once a darling of retail investors, but she's had numerous disastrous errors, such as selling Nvidia at $20 a share when it's $140 right now. This has resulted in her losing out on billions of returns and has cost her her reputation. This lovely section on her Wikipedia summarizes her intelligence and love by the investment community. To make it clear, she is ranked higher than other brain-dead traders not because of her trading skills. She's a degenerate like all the rest. It's because Cathy Wood can raise her wood. Number 3. WallStreetBets. Now, the lack of brain cells is really starting to show here. I almost feel sorry for them losing everything, but then I remember that they have nothing to lose anyways. These YOLO trades are high risk, high reward, and often high stupidity. They often bet mortgages, life savings, and tuitions on risky financial derivatives, expiring the next day. There was even a user who bought $18,000 on Gourd futures and by mistake took physical delivery of these long, phallic-shaped vegetables. The only way a WallStreetBets user loses money more slowly than the rest is that if he found a way to diversify his loss-making. People have tried teaching them to just buy and hold, but let's be honest, if it doesn't involve margin calls and instant regret, they're not interested anyways. The goal of these almost brain-dead investors is for their stocks to go to the moon, and then to buy chicken tenders with their winnings. The sad truth is that chicken tenders on a plate will be the only thing that will ever be spread out for them, waiting for them to eat it. Number 2. Crypto. Crypto traders are the Wild West cowboys of the investing world, except they're always in their mom's basement. They ride the wave of digital currencies like Bitcoin, Ethereum, and countless altcoins, where prices can skyrocket or crash with a single tweet. Driven by a cocktail of mind-numbing stupidity and speculation, these traders operate in a space that's as volatile as it is exciting. They often think that they're going to revolutionize the financial system and end the US dollar's reign as the reserve currency of the world. One event which definitely killed those dreams is the FTX scandal, which rocked the world of crypto in 2022. Billions of investor funds seemingly vanished overnight under the helm of Sam Bankman-Fried, and it was a crash that most people didn't see coming, because they were fucking blind. Now, they say that money can buy you a hot woman, like our good friend Jeff. Then, what in God's good name was Sam doing? A rug pull is when a developer will say, the new platform is the next biggest thing. It will revolutionize the blockchain. Watch this space. We will destroy fiat currencies. When the token spikes, the developer will liquidate their entire stake, tanking the coin to zero in a split second. A perfect example of a rug pull is the Squid Game token, which was made due to Squid Game's popularity, and it ended up losing all its value in a split second. And thankfully, we got to watch this live on stream.
$68 trillion. And now the market, it went to zero!
This stupidity here is not from the scammers, it's from investors, purchasing a functionless token because it's named after a show which is popular right now.
Sayonara, mother!
And don't get me started on your NFTs and your CryptoPunk worth $12 million. You need to be brain dead to pay that much because whoopsie daisy, guess who just copied your unique artwork? Number 1. GameStop and AMC. GameStop and AMC investors are the more brain-dead, acoustic, inbred relatives of WallStreetBets. These people were originally part of WallStreetBets, but they were genuinely too stupid and too acoustic even for WallStreetBets. People who bet their life savings on risky financial derivatives expiring the next day. They literally call themselves apes, and this is pretty fair as their intelligence is basically the same. I feel sorry for these virgins, but then I remember, hey, they're not gonna be virgins anymore due to the big red dildo coming from bankruptcy. AMC has literally been diluted 1,250% in the last 5 years. And who would have guessed it? The stock is down 95%. Some of these geniuses actually think it's going to go to $1,000 a share, which would make it worth more than Toyota, Ford, and General Motors combined. I propose that we start an educational program to help these apes become a bit smarter. We can start with the absolute basics, like shapes. This is a pentagon, this is a hexagon, this is an octagon, and this is your portfolio gun. We took down Wall Street! No, sweetie, you helped some hedge funds on Wall Street make a few billion by causing a short squeeze. Then, you stayed in the trade while the price went down. But who cares about facts? Now who's a good ape? If you enjoyed this video, I would appreciate it if you like and subscribe. I'm Drew, thank you for watching, and see you next time.